Hi everyone, welcome to my channel. In today's video, we are going to talk about a book called Capital Returns, which is compiled and edited by Edward Chancellor. This is a very underrated book among the global investors. This book is a collection of letters to shareholders from Marathon Asset Management Company UK to their shareholders and explaining them how they are achieving market beating returns year after year by studying the capital cycle of the economy. We are going to talk about capital cycle, supply side view, companies' earnings, CEOs' incentives, buybacks, mergers and acquisitions, and also interest rates, how it's going to affect the business returns. Most of the investment books which will talk about the demand side of the business, what is the people's requirements, how we are going to solve them, and how cheaply you are going to solve them. But this book will talk a lot about supply side of the business. We know a lot about Michael Porter's competitive strategy. It's been years old. But these guys achieved maximizing returns by studying the capital cycle, which is going on in the economy, in particular sector, in particular businesses. When you analyze the supply side of the businesses, you can be a better investor and also a better businessman. Like, water is so cheap comparing to gold. Why our basic needs cost less comparing to the luxury of gold? Because water supply we have is enormous comparing to gold. Even we have a technology to convert salt water to a drinking water and satisfy our needs. If you just observe what is happening on the economy, you can pick the point and a clear view about a capital cycle. For example, let us assume in a particular area a business park is coming. There will be 50,000 to 1 lakh employees is going to work on that business park. Then all of a sudden a housing demand will occur. What's next? The person who is already having the apartment over there or else going to start the construction immediately will reap maximum benefits. After seeing his maximized returns, every Tom, Dick and Harry will come with capital and construct an apartment over there, and then the supply will exceed the demand. For example, for a 50,000 employees from that business park, the maximum housing demand near that business park will be 3,000 to 4,000 apartments. But when the excess capital comes in, there will be a supply demand mismatch. Instead of 4,000 homes, there will be 8,000 homes will be constructed. And then the returns, for example, in the first building, the builder is selling the apartment for 1 crore. After getting into the supply demand mismatch, that same kind of building will cost around 70 lakhs, which is 30% less, which will affect the return potential of the capital which are invested. The same kind of scenario will happen often in the pharma industry. For example, if a pharma company finds a drug which will clear your fever in half a day, then after seeing the maximized returns, what other companies will do, they will invest very heavily and then find some other combination, and the end of the day some company will crack the code and get the tablet to work in 1 day instead of half a day. Now your fever will get cleared in 1 day. What they will do is, because they have a enough supply of capital, they will place their tablets prices probably 70% less than the company A's tablet. What people will prefer? They will prefer the cheapest one, and then the company A's returns will be vanished. When the excess capital flows in, the supply will be created more than demand, and then it will affect the returns, not just for the one company, for the whole businesses, whole sector. So, by analyzing the capital cycle, we can ignore the bad businesses. Like Charlie Munger used to say, ignoring bad businesses is very important than picking good ones. If you ignore bad businesses, end of the day, you will come to find a good one to invest. I hope now you understand not all businesses will grow constantly. So, paying premium valuations for a share price will end of the day affect your returns. I will give you a short example. There is a company called 23andMe. You can check in Google. This company launched a product which is going to do a DNA test from your mouth's saliva and at a affordable rate. For example, in the US dollars, it may be cost 1,500 or 2,000. Everyone bought the kit and they are uploading the status in WhatsApp, Instagram, in every social media and all. The company's earnings kept on growing for few quarters. All the private equity which was invested in the company got exit. Okay, only retail people and mutual funds bought it. Then, when an individual bought the kit and do the DNA test and got the results, do you think the same individual is going to buy the DNA testing kit again? No, right? Then, after the peak, the company's earnings started to come down. Now the share price is 90% drop from the top. So, if anyone invested 1,000 rupees in that company at the peak, now all he will be having is 75 or 80 rupees of his hard earned capital. Good capital allocating management or CEO will maximize your returns. For example, a company is doing good business in a particular country, they can expand their business to the neighbor countries step by step rather than expanding furiously into many countries and buy assets with the debt and end of the day spoil your returns and then business will go bankrupt. Keep in mind one important thing, you can earn 20% return in a small capital, but you can't earn 20% return in a larger pool of capital. For example, if VMart is getting a return on investment of 15%, doesn't mean Reliance can earn 15% in the same business in the same field, because Reliance pool of capital is by far very large comparing to the other retail companies. Family run businesses which are grown only with the help of the political influence and political support for the founder or a CEO can't sustain in the future after the demise of the founder. And kindly analyze and get to know how the particular company is paying to its senior executives, how the incentives are worked around. For example, if a company is paying incentives to the CEO depends upon the earnings growth and then market value growth, what CEO will usually do is he will fire some of the executives and then do all the cost cutting measures so that it will increase the reserves. When the reserves got increased, investors say, oh, the CEO is doing the work brilliantly. What next he will do now? Since we have all the reserves, he will buy back most of the shares at the high peak value. Once the shares got bought back, the outstanding shares will get lesser by lesser quarter by quarter. Even if the earnings got constant or else no low growth, the EPS will get to grow because of the outstanding shares getting reduced. Low interest rates will boost the economy artificially, because if a company is getting a cheap debt like COVID, which is 0% or 1%, they will borrow as much as possible and then repay their highest interest paying debt and also buy back their shares. Because of these two things, the debt will get reduced from the balance sheet and also outstanding shares too will get reduced quarter by quarter. It will artificially boost the EPS. So, when a company is buying back its shares, you have to analyze as an investor to know the details. Why this company is buying back its shares? Is it really worth? Is it really undervalued, or else the company is buying back its shares because of the cheaper debt or else CEO's incentives. Next up, when the cheaper debt is available in the market, all the companies will borrow and do stupid acquisitions and mergers at the high peak. And we all know what are all the messes the company Cox and Kings did to their investors by doing dumb acquisitions and mergers all over the world with the debt. So kindly keep distance with the company which is doing acquisition and mergers so often. And then when a company is coming for an IPO, you have to analyze why this company is coming to the market at this time, because they have a new businesses or else they are expanding or else just want to get into the market because now they are getting a good valuations. Now we all know Hyundai IPO. Before the IPO, they took off 15,000 crores of reserves from the Indian company to the parent company as a dividend, and then they launched 27,000 crores of rupees in the Indian share market. Just imagine how ethical it was. And finally, when the interest rate rises, the low margin companies will die first. When a company is earning a good profit margin of 20% or else 15%, even if the interest rate climbs up to 2% or 3%, the maximum they will be losing is 2% or 3% of their profit margin. But imagine when a company is earning 5% as a profit margin, when the interest rate climbs to 3%, this company's profit margin will be lesser than the cost of capital. They have to borrow and they have to repay, they have to issue more equity. End of the day, it will be a vicious cycle. It will drag the company to the bankruptcy stage. Ignore companies which are paying equity for the mergers and acquisitions. For example, if you are a shareholder in that company, when a company is paying equity for the merger and acquisitions, the shares will get expanded. So the dividend which you will be getting will get distributed to the new shareholders. Okay, your dividend will be less. See, if your company is having a 1 crores of profit, the management will sustain because they have cash in reserves or surplus or whatever. But as a shareholder, we will get benefits only if the share price got appreciated and then if the company gives us a dividend. That's all. These are all the points which I learned from the book Capital Returns. I hope this will help you in your investments and maximize your returns. If you like this video, kindly subscribe to my channel so that you will never miss any of my financial update. Thank you so much for viewing and also listening to my podcast. Let's get rich together.